Welcome to another FSA video where you're going to talk about Teck Resources today. Teck Resources is as you can imagine, a resource company. They're in three main products. Actually, I should say more than three main ones. But the biggest one is steelmaking coal, also known as metallurgical coal. There are different types of coal, and it's important to make that distinction. There's coal for fossil fuel burning, for energy, but this type of coal is in steel making process. It's a chemical that's needed to make the steel stronger, make iron into steel, basically. So it's really important to make that distinction. The other products they are in, or bigger ones, are copper and zinc. So those are the main ones. They also have some energy, like oil sands. So well-rounded, well-diversified, but most of their 50%, pretty close to 50% of their business is in the steel making metallurgical coal. Okay, let's jump right into what our valuation models say. Here is Teck Resources. What strikes us, number one, is the strong correlation between improving return on invested capital or declining and the stock price. So back in 2001, 2002, 2003, very low returns. Stock was not doing anything great. And then all of a sudden, the returns started to improve, and you can see the stock prices improve. So the return are the bars. The stock price is the mountain-looking type yellow chart. Right at the peak of return on invested capital was the peak of the stock. Returns started to come down. The stock moved around a little bit. But right at the bottom of return on invested capital was the bottom of the stock chart again. The stock took off a little bit before the returns did in this scenario, or this area of time. But it did somewhat correlated. As returns were improving, the stock was improving. Then all of a sudden, returns weren't going to be sustained or weren't going higher. So the stock came off. Right at the very bottom of return on invested capital was the bottom of the stock. That's a pretty close indicator of using return on capital as a good indicator for this company. And now we see improving return on invested capital, stock's improving. We have a very conservative forecast. The forecast is this dark blue, and we actually fade the return a little bit, put very little capital growth, and our valuation is still a lot of upside. So that's number one thing we see when we run the company, and then we start to dive in. But this is our proprietary work, and then we want to dive in. Okay, so cyclical companies can be difficult. As you can see, the stock has been up and down, but they do follow the return on capital. So returns moving forward, that's great. Let's take a look at some of the underlying prices. So the number one product, as I said, was steel-making coal, or metallurgical coal. And it's about 50% of their business. So how has pricing been in that area? Well, let's just go right to their website. And they have their principal products, steel-making coal. And here you can see right on their website what their average price per ton. So let's say in 2012 it was 193, 2013 it was 149, 2014 115, and then bottomed out in 2015 at 93. To 2016 improved to 115, 2017 improved to 176. So improving prices of the underlying commodity of metallurgical coal. Perfect. Copper, well, we could look at their realized copper price, but I think it's better shown in the world price of. Here's a 5-year chart, and you can see 5 years ago copper was just over $3.50 a pound. kind of trickled down to June 2017 and has been rising ever since, and it's just over 3, looks like it's 3.20 per pound right now. Okay, that's their second biggest commodity. Their third biggest is zinc. So around $1 a pound 5 years ago, bottomed out May of 2017, around 70 cents, maybe slightly below 70 cents, and has now powered up to about $1.60 a pound. Okay, so the three biggest commodities have significant price increases in the last 2 years, year and a half. That's super, and it's no surprise that if we flip back to our chart and look at the return on invested capital, it's also improving. That's the way commodities work. Return on capital improves when pricing improves. So we're in an improving pricing environment, and should that continue? Well, I'm going to say probably yes. Certainly don't want to say I'm an expert in where commodity prices go. It's a very difficult thing to predict, even if you were an expert. But we know these things. We know commodity prices are tied to the strength of the economy and the world economy. The world economy is getting stronger. So not just in Canada, US, but around the world. And that really drives the price of metallurgical coal, copper, and zinc. Okay, so that's a big consideration that the economy is improving. Also, there's been a lot of talk of inflation, and that's somewhat because of the economy is improving and you get inflation in that environment. But inflation is not necessarily a bad thing for commodity companies like Teck Resources. So there is, I'm going to call this at least medium risk, maybe higher risk than most, because it's a cyclical company. Now, there's nothing wrong with Teck Resources itself. There's no risk of that being a, I don't know, a fraudulent company or just not a good high quality company or anything like that. This is a high quality company. It's tied to the commodity, so that's why there's risk. It's the commodity risk. So that's our investment thesis for Teck Resources. Happy investing.